The impact of an increase in interest rates on your mortgage. We are talking about that today with wealth and estate planning specialist Adam Buss. Adam, thank you for joining us.
Thanks for having me again, Rob.
All right, so macroeconomic situation. Inflation was starting to get out of control. The Canadian Central Bank decided that they would increase interest rates. They increased them a few times, but most recently 75 basis points. The US Central Bank did the same. And there's a forecast for continued increase rate adjustment over time, over the summer months and likely into 2023. So what impact has that had on the banks and their mortgage rates, Adam?
Well, as people can see, and it's probably all over the news these days, is that rates are going up. Mortgage rates are going, above where they have been. I mean, the last year and a half through the pandemic, we've seen essentially historic lows for interest rates, which is clearly not the norm as to what we should all be used to either when it comes to buying houses and paying, 1.5% for a 5-year fixed rate. I mean, that's just a ridiculous opportunity for cheap money. So now that rates have gone up, they've done 4% swing in the other direction, especially on the fixed rate side. So people are really seeing that when it comes to going and buying a house, maybe their mortgage renewal or refinance, and now they're stuck paying a much higher rate than what they thought they could get access to.
Okay, so take us through the three different types of, or maybe there are more. So there's a fixed, the fixed interest rate. There could be a variable, and I guess there could be some sort of hybrid in between.
Yeah, I mean, you could always do a blend, right? And say I want to have part of my mortgage as a variable, part of it as a fixed, just to again maybe hedge your options as to which way rates are going to be going. There's a variety of fixed terms: 1, 2, 3, 4, 5, 7.
And what is a fixed term, Adam? What is
fixed
a fixed term?
Is saying that I'm going to lock in my interest rate at a fixed percentage over a 1 year to 5 year term. Let's say 5 year being obviously fairly popular. So I'm going to pay X percentage for that 5 year time period. No matter what's going on in the news and what's happening with interest rates today, that is the contract rate that I'm paying. That is the contractual obligation from the bank to me, and vice versa.
Now, the variable rate, it moves with the prime lending rate, I would imagine?
Yeah, every bank does set their own prime, but typically the prime rate is going to change based on what Bank of Canada is doing. So you're going to see, especially in the last little while, that Bank of Canada raises interest rates. You're going to see the bank prime rate change, which is impacting your variable mortgage rate, your line of credit. Perhaps you have some personal loans as well. And those are directly impacted when the Bank of Canada announces a rate change. Those are going up or down based on the Bank of Canada change.
Okay, so let's say I have a mortgage with a major lending Canadian institution. Interest rates are going up. I'm panicking. I'm fearful. What are my options, Adam?
Well, I mean, your options are to continue to ride the variable and just say, okay, perhaps I have the view that long term, I still feel the variable is going to be the best choice. Maybe knowing that temporarily I may have a little bit more, up versus downward component to it, but I know that I'm still comfortable with that risk level of the rate changing moving forward. So that's option one. Basically, just continue to ride that wave. Option two is saying, this makes me uncomfortable. I want to switch to something guaranteed where I don't have to worry necessarily about my payments changing or what it's going to cost my family on a monthly basis to maintain my home. And then you're locking in for a fixed rate at whatever the rate is at that point in time. So part of the challenge today is, the fixed rates especially have priced in a lot of extra rate changes already that the variable hasn't necessarily caught up to. So, I mean, just today, having a quick glance, I mean, there's well over a 2% spread between the current 5-year fix that you could lock into today and the current variable rate. So that is a big difference between those two options today. So you're basically saying I'm locking in a payment and saying, I know that I could maybe save money on the variable side, but I'm locking in a higher interest rate guaranteed today.
The key, and I like how you worded that, it's pricing in. The banks are not silly. They know that the Bank of Canada, the lending institutions know that the Bank of Canada has a plan to increase interest rates, and therefore they've already moved the needle. They've already said, listen, we got to charge more for fixed, because if you're locking in fixed, you're mitigating your risk. So the bank has to take some of that risk off the table as well. So therefore, they're putting their 5-year fixed way higher. So that 2% spread between variable and fixed, I believe it's some of the highest we've seen, right, in a while, because the market is pricing in so many increases.
Yeah, I'm going to say historically, and I haven't gone back and fully fact checked this, but I spent a lot of time in my lending career. The variable and the fixed are generally very close to each other in a normal time period. Maybe a slight interest rate differential, but not dramatically so. Not 2% worth of difference for sure.
Yeah, like that's eight 25 basis point increase hikes that the banks are expecting, because if the variable is too lower, they're thinking, well, this thing's going to keep bumping and bumping by about 2%. Now, what if you have maybe 6 months or 12 months left on your mortgage contract? Do you have any options there?
Well, again, the options are the bank is always typically going to offer you an early renewal, which again, you can say, I'm going to exit my perhaps a lower interest rate that you're paying today on your mortgage that you locked in, 4.5 years ago, and say, I'm going to exit that contract and lock into the higher rate today, or I'll continue to finish my contract, see where rates are, 6 to 12 months from now, and then I'll renew it for, a 1 year, 2 year, 3 year, or etc., or go to a variable at that point in time. So you have choices. And again, it comes down to your individual risk tolerance. So it's kind of like same in the investment market side. You have a risk tolerance saying, do I want something guaranteed, or do I want a little bit of the unknown, but I know the trend should be there and I should be comfortable in the end. Some people also don't like the unknown that their payment may change on a monthly basis when the Bank of Canada announces a rate change.
Yeah, we're big believers, you and I, of planning and making sure that you take a look at what's coming 6 months, 12 months, 2 years down the line, and you take a look at your cash flow. And if you're in a position where the budget is incredibly tight and you're going to have a hard time making those payments, you need to start planning on that now, because you need to either, figure out a way to save, figure out a way to create some additional cash flow, because we know for a fact that when your mortgage renews, it's going to be more expensive. Now, you can extend your amortization, perhaps you could look at things like that, but largely, assuming interest rates stay where they are now, you're going to have a bigger payment. So planning is important. Wouldn't you agree?
Planning is absolutely important. And again, everybody's got a different cash flow. Everybody's got a different budget. Nobody wants to pay more on their mortgage. That's for sure. That's not fun for anybody. But what are the options? So let's just use a dollar amount example. So let's say you got a $500,000 mortgage. You got the option between variable and fixed today. Well, fixed rate, you are guaranteed your monthly payment is going to be about $660 a month higher than what the variable is today. So that is guaranteed. That is what you're going to pay higher on the budget, versus on the variable side, you will likely creep up over time, but not a guarantee from day one. That is how much more you have to commit towards your mortgage payment.
And if the central bank ever decides to slow things down a bit and not increase it as much as they decided, that variable is going to look a heck of a lot more attractive than that fixed. But who knows what's coming down the line? I do think we're going to see interest rate hikes, but at what level? That is a tough one to call for sure. Adam, anything else on your mind with respect to mortgages?
So just a quick chat about pre-approvals. So some clients may have gotten a pre-approval. They're in the middle of house shopping. There's a lot of people that were trying to find a house in the crazy market and couldn't necessarily secure one, so they may still be shopping. Their pre-approval numbers may have changed dramatically as well as interest rates have risen. We use stress tests to calculate as to what somebody would qualify for on the mortgage. As interest rates rise, that stress test becomes a little bit more stringent and lowers the amount that you would qualify for when going house shopping. I'll use another quick example for you. Somebody that maybe 5 months ago could be qualified for a $500,000 home purchase, now with the new stress test on a fixed rate would only qualify for about $420,000. So that is a dramatic change as to what their dollars can buy them in the housing market.
Right. In theory, in an efficient market, in my courses in my MBA, they would tell you that inflation should take care of that. Your earnings should go up over time, and your revenue should compensate for the fact that you're going to pay more on the interest rate side. But we do know that that's a laggard, right? We're not going to see increase in salaries tomorrow. That might take 6 months or a year or 2 or 5 years before we see the full built-in inflation in the salary and the wage gains for the Canadians. So you do have to be careful these days. It's important to make sure you're planning properly.
Yeah. So discuss, again, if you have these concerns, discuss them with your advisor, discuss them with your mortgage specialist, find out your options. If you were pre-approved, double check it. If you are still pre-approved today, how the numbers have changed so that it's based on current reality and you don't go and make an offer on a house and then end up disappointed.
Yeah, we don't want that for sure. And again, Adam, you're a certified or a registered mortgage broker as well. So you've helped many clients find the right debt solution as well. So we do value your opinion and your input here. Head of Wealth and Estate Planning with the Tetrault Group. Thank you for taking the time today. If you'd like to book a no obligation consultation to chat about this or anything with respect to investments or your investment portfolio or your financial plan, please go to www.speaktorob.com and we'd be happy to book that for you. Adam Bus, thank you. I'm Rob Tetrault. I will see you in the next video.